Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Dominic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Dominic Rinaldi.
I am lucky to be joined today by Matt Somma, the Vice President and Transactional Risk Broker in ABD's M&A Advisory Practice. ABD is an employee-owned insurance brokerage headquartered in San Francisco. They specialize in M&A risk management, insurance brokerage, human resources, and retirement consulting services. Matt is an attorney that has spent most of his career prior to joining ABD focused on M&A transactions. Matt and I will be discussing the ins and outs of rep and warranty insurance and how this type of insurance impacts buyers, sellers, and the negotiation process. Matt, welcome to M&A Unplugged.
Thank you very much, Dominic. Happy to be here.
Yeah, I'm so excited to have you here because this is something that we haven't touched a lot of in our practice. So I'm going to be learning along with our audience here a bit, and I'm excited. But before we get into the definition of reps and warranty insurance, how about a little background on yourself and on ABD so the audience knows a little bit more about you and the company?
Sure. Yeah. So let's start with ABD. ABD, as you mentioned, is a San Francisco insurance brokerage founded in 2012. We have a stable of tech clients in the Bay Area. We're about 350 employees and somewhere around $100 million in revenue in 2019. We're growing at a very fast pace. The newest practice at ABD is the M&A advisory practice, which was founded about 2 years ago. And I joined last year. I followed a fellow named Josh Warren, who was at Equity Risk Partners, which was sort of the first insurance brokerage to focus exclusively on private equity. So Josh started the practice at ABD. I followed suit last year. My background is that I was a big law attorney for about 12 years. I started at a California law firm called Paul Hastings, and I finished at a Virginia law firm called Hunton and Williams, where I was a counsel in the project finance and M&A group. When I practiced law, I focused pretty much exclusively on private equity sponsors who were engaged in M&A across the middle market. I had a specialty in energy transactions, and those transactions typically involved some sort of acquisition or project financing. I left the law firm world to start underwriting reps and warranties insurance a few years ago, right when reps and warranties insurance was becoming a very sort of a game changer product in the M&A space. And I started underwriting at the Hartford and then switched to what's called a managing general underwriter called Blue Chip. And I underwrote reps and warranties transactions for about 3 years before joining ABD on the brokerage side. So the underwriting side, you're taking the risk, and on the brokerage side, you're placing the risk. So ABD doesn't bear any risk, but we look for insurers who will take on the risks of reps and warranties transactions.
Well, and having been on the underwriting side, you know this product inside and out, I'm assuming. And that, coupled with your law degree and your law experience, gives you tremendous leverage, I would imagine, to bring this to market. So I'm excited to really get into this topic with you. So why don't we start, Matt, with what is rep and warranty insurance? How long has it been around? How did it come about? Give us the history on it.
It's a great product. This product, you can think of it mostly as an escrow replacement product. So I started practicing law in 2003. And when we did M&A deals, as you know, Dominic, in 2003, you used an escrow account. This was sort of fundamental to every transaction. You would place 10, 15, 20% of the transaction value in an escrow account. Buyer would give seller, let's call it 90% of the proceeds of the purchase price, and the remaining 10 would go in an escrow account. And that 10% would sit there for a year and a half, 2 years. And that money sat there with a bank, and the buyer would be able to make a claim against the money if there was a breach of the purchase agreement. And this was the way deals were done for a really long time. Escrow accounts worked okay. Attorneys spent a lot of time negotiating indemnification terms and purchase agreements, how the escrow was going to work, how claims were going to be made. So it was a process that was okay, but it was never totally efficient. In the European market, in probably the early 2000s, reps and warranties insurance was born. And insurers, being the smart people that they are, always looking for opportunities, realized that the escrow product was sort of an inefficient way to run a deal. And the reason for that was the time value of money. The money was just sitting in an escrow account waiting for people to make claims and then eventually litigate or not. So insurers came up with a product, and I wish I had invented it. I wasn't the one who did it. They came up with a product that really replaced the process. And they said, look, give a seller most of its money now, or all of it, and place the rest of the risk with us. And we'll underwrite this transaction. We'll get comfortable with the risk. And you, seller, can walk away and buyer can insure over the risk. And we'll bear that risk. So the product has been around. It never really took off in the United States for a lot of reasons, mostly the way deals were done and the way law firms worked. Probably in around 2010, you started to hear whispers of this product. But no, I never really used it on a deal, and it was really kind of infrequent. The real year for this product is 2013, 2014. It became a major piece of M&A transactions in the U.S. middle market. It really took off. And the reason for that is private equity got wind of it. And private equity knew that this was a much more efficient way to, first of all, win a deal. Because in a competitive market, a private equity fund making a bid with a full release to a seller, a full release of purchase price proceeds, that bid was going to be way more competitive than an alternative bid that required an escrow. So that's really the main reason why the product started to be used. Was it was just a great way to win deals for private equity.
Well, that's a tremendous history. I really appreciate you giving us the background on that. Let me ask this question, though. It obviously comes at a cost to the buyer. So what's the incentive to the buyer to do this when it is going to cost them something? Whereas before, they could just retain, put that 10% aside, and it really didn't cost them anything to do that other than, the negotiation of an escrow agreement. I get that it makes them more competitive in the marketplace against other buyers, but it does come at a cost, right?
It does come at a cost. The cost has come way down, and that's part of our history in the reps and warranties market. One of the issues for the product not being adopted quickly in the United States was people said it's too expensive for what I'm getting. Insurers got wise to that. The prices adjusted, and the price came way down over the last few years as more insurers entered the market. The real reason, though, I think buyers still love the product is it's the competitive advantage in winning a deal. And it's the terms that are in a reps and warranties policy, as well as the idea that if there is a claim, the buyer isn't making a claim against, for instance, a management team that's rolled over. The buyer is now, all claims run through sort of an independent third party, being the insurer. So a buyer who's making a claim against a management rollover team or under the purchase agreement no longer has to sort of go through that awkward process of litigating against the people that buyer is now working with. The process has been separated out to an insurance company, and the terms are favorable and they're clear. The reps and warranties insurance policies are pretty clear. Insurers have a good history of paying legitimate claims on time. So I think buyers have been satisfied with the process and are willing to pay. And often, Dominic, the costs are split between buyers and sellers, or sellers.
Oh, interesting.
Yeah.
Well, yeah, because there's a real benefit to a seller, right? I mean, now potentially they're walking away with 100% of the proceeds, assuming there's not an earnout or some other things, right?
Exactly.
Walking away with 100% of the proceeds. So there's a real advantage to them. And I could definitely see from a buyer's perspective, the advantage being that they're more competitive in the marketplace, and like you pointed out, they don't have to go litigate if there's a problem against the former manager or owner or the current management. I mean, it just makes for a cleaner process. Tell me, how does that play out, though, in negotiating the reps and warranties in the actual asset or stock purchase agreement? So now, is there a heightened negotiation around reps and warranties, or is there less concern about reps and warranties, and is it easier to get through that process?
It's a good question. I would say that purchase agreement negotiations have stayed stable. Perhaps they've sped up a little. Maybe that's the right way to frame it. I think the reps and warranties themselves have pretty much stayed similar to the way they've been for the last couple of years. Underwriters in the reps and warranties market require reps that are within market. And almost all underwriters in the reps and warranties market are former M&A attorneys. So they know the terms of purchase agreements very well. So occasionally a buyer will request reps from a seller that are sort of more broad than would normally be seen in the US middle market. An underwriter who's insuring that deal will sometimes push back against reps that are too far beyond what can be insured. So an example of this would be a rep where a buyer used to make a representation and qualify that representation by knowledge. Sorry, if on the sell side, the seller would make that representation and qualify it by knowledge. If a buyer requests a rep like that to have their knowledge qualification removed, and it makes it too broad of a rep for an underwriter to cover, an underwriter will ask that knowledge qualifier to be inserted again. So there's a governor on the process in that the underwriters know the market so well.
Oh, that's interesting. You've almost invited a third party into the negotiation around these reps and warranties. If they're too light, they're going to come in and push that the buyer tighten them up. And if they're too loose, the other way around, right? So that's interesting.
It is. The underwriters know and the brokers know that this product has to move as fast as the deals. So anybody who tries to insert themselves in the purchase agreement, 2 days before closing, you better have a really good reason for entering into a document. So I would say that the underwriter and broker touch on a purchase agreement has to be light. And so we encourage people to show us drafts early and often so that we can be running with the deal and not, the day before closing saying there's reps here that can't be covered. These underwriters move really fast.
Yeah, so let's talk about the process a little bit. When do you typically get involved in the process? How long does it take for you to figure out where to place it? And how long does underwriting take and what's involved in underwriting? Maybe step us through what a typical process looks like. And I'm assuming that probably 95% of the time it's the buyer that's coming to you, right? I mean, rarely I would imagine a seller is coming to you for this, correct?
You're right. This is a buy-side product.
Yeah. So if you could bring us through the process.
Yeah. So I'd say the process I love to see is around 2 weeks prior to signing or closing, get in touch with the broker. So the broker at that point needs to do a few things. First of all, they need to get a handle on your deal, understand the deal terms, the industry that you're in, any specific items that are heavily negotiated or that are hard for an underwriter to cover. The broker will then look over your purchase agreement, and they should be letting you know as early as possible whether or not that purchase agreement can find coverage in the market. Most of the times the answer is yes. The broker should also be looking at the sort of fundamental documents in the deal that an underwriter will need to see. And those are the financial statements, at least to get started, the financial statements and some sort of offering materials or information about the company. The broker then passes that information along to underwriters who have shown an interest in that type of industry or with this particular type of client. So there are about 20 underwriters in this market, 20 underwriting shops. Some are traditional carriers, some are what we call managing general underwriters, and I can talk about the difference. But the broker is sending this information out to usually not all 20, but a number of markets. The markets then respond back to that broker within a few days with their interest level on a deal. It's called a non-binding indication letter. And the underwriters will have done some research on the company, looked at the financial statements, looked at the offering memo, thought about the industry, thought about the purchase agreement, and then present an indication back to the broker of whether or not they're willing to insure the deal and on what terms. And that's important to kind of remember that the insurance is being placed around that purchase agreement. Sometimes people ask me, well, are they insuring the whole company? And really what we're doing here is we're insuring over breaches in the purchase agreement. So that's the document that the underwriter will be laser focused on. And once the bids are back in with the broker will report back into the client. And walk through the bids, which takes around a day or two to kind of go through things and get it sorted out. And then an underwriter will be selected. Once that underwriter is selected, the buyer will be asked to pay an underwriting fee, which is non-refundable. That's paid to the underwriter and usually passed through to the underwriter's law firm, who's also going to be doing diligence on the deal. The underwriter then gets access to the data room, the electronic data room, and the underwriter will request that the buyer provides copies of its diligence reports so that the underwriter can look through what the buyer has done. And those diligence reports include a legal due diligence report, a tax due diligence report, an accounting due diligence report. And if the target is not audited, usually most underwriters will require a buy-side quality of earnings report. And there are exceptions to every deal, but most of the times those are the documents people should think about in order to get the process started. Once the underwriter has those things, it only takes a few days for the underwriter to zip through them with their counsel. And then the underwriter will hold an underwriting call with the buyer, about 2 hours, where they'll ask a series of questions about the diligence that the buyer has done. And at the end of the call, the underwriter will send a few follow-up questions, and the buyer and the underwriter will negotiate a policy. So all of that sounds like a lot, but the process is really well refined by this point. Most insurers are providing policies at this point that are well established within the market. So this is another reason why how this product has grown. The policies have become more efficient. The insurers know what brokers are looking for. And so the process is really fast at this point. The buyer can really get this done. As I've seen this done in 48 hours, but I would never recommend people do that. That's really a terrible way to get a deal done. Really, I think the good rule of thumb for people to keep in mind is 2 weeks is totally reasonable, and it gives people plenty of time. A week is okay. And once you get under a week, it gets hard. But these underwriters they're very hardworking people. They're very smart. They're all former lawyers. They know how to get a deal done quickly. So it's the process. I've never seen the underwriting process really hold up a deal. It just doesn't. Everyone knows that this product really relies on speed and efficiency.
Well, it's really impressive though, because running an M&A firm and doing as many deals as we do, we run these data rooms, and I see how many documents go into these data rooms. That's very impressive. I'm surprised it's only 2 weeks, because we could have thousands and thousands of documents that go into a data room. So to have to sift through that, plus all of the other stuff that is coming at the underwriters, that's impressive.
But remember, the underwriter they're in your data room and they're looking at the documents, but they are not diving in. I tell people, this is not like lender due diligence on an acquisition financing, where a lender is sort of breathing down your neck in order to understand the diligence you've done. The underwriter is looking, and this is a major part of the underwriting process. The underwriter looks for buyers who do excellent diligence and provide great reports. This is how we've gotten to this point where people can be as speedy as they are. So an underwriter is going into the data room and checking an overall view of the data room, and then asking their counsel, dive in if you see litigation in the data room. So it's not like every page of the corporate file of the data room with all the corporate formation documents and everything it's being looked at, but it's being looked at a much faster pace than you would.
Understood. Yeah. Understood. So, Matt, what does a typical policy look like? What's involved in that policy? What are the typical terms and conditions? I'm sure that, terms and conditions can vary greatly based on the industry and type of deal, but just at a high level, what are the basic things that are involved in a policy like this?
Sure. Yeah. The policy it's different than a typical insurance policy, I would say. This looks more like a contract, and it looks more like a contract that corporate lawyers and deal professionals would recognize. And it's set up that way to work with deal people so that they can work with it and negotiate around it. It includes, first of all, who the insured is, and that's usually the buyer. It includes what's being insured, and those are the representations and warranties provided in the purchase agreement. The insurance policy will not include covenants. So that's a common question, is, can I get these covenants insured? And the answer is almost always no. Covenants are not part of what this product does. This product is strictly on what you're telling me today about the company, and not what's going to happen in the future. The policy includes the price And the policy includes exclusions. And those are items that an underwriter will raise during the underwriting process, hopefully beforehand, if they can, in the indication letter stage. And those are items which they're essentially known issues that a buyer is walking into a deal and saying, for instance, I know there's a litigation between party A and party B, and the underwriter sees that, and known issues such as a litigation wouldn't be covered, and that would be clearly outlined in the policy. This policy is covering unknown issues. So I'm sorry to sort of walk around this issue, Dominic, but it's an important one. People say to me a lot, is my policy going to cover fraud? What if the seller lies to me? And that's precisely what the policy is protecting you against. So if a seller knowingly provides misinformation to a buyer and the buyer makes a claim on the policy, that's a legitimate claim. Now, what happens in that instance, and this is also a piece of that policy, is the insurer retains a right, in the instance of fraud, to subrogate against that seller. So the insurer is still protected and the buyer is still protected. It's the only real time in a deal that uses reps and warranties insurance where a seller remains on the hook for anything. This is a clean walkaway product.
And so is the seller a party to this agreement? Or no, they're not. Okay, got it.
But they do retain a subrogation right. The insured does retain a subrogation right against the
Understood.
seller. Yeah.
Understood. Okay. Are there things in these policies like, you talked about carve-outs. So Matt, are there deductibles in these policies?
There's a retention. We call it a retention in the insurance world. And that is the amount the insurer will require someone to bear the first, usually 1% of the risk. The retentions have come down in the last few years. Retentions used to be around 2%, and they're now down at around 1%. So the retention will be in place for about a year, at which point it will drop down to around 0.5%.
So how exactly does the retention work? Just describe, maybe you can give us an actual example of what's a policy amount, and then how does the retention kick in if there's a claim? And is it a one-time or is it per incident? How does that work?
Sure. So it's a retention that kicks in immediately, and the claims are made against it, and they aggregate over time. So once you reach the threshold, so let's talk about a $100 million deal with a $10 million policy. There'll be a 1% retention. So that's $1 million. So the first $1 million is on the buyer. The buyer bears the risk, or the seller, of the first $1 million of claims.
Depending on how they negotiated this in the APA or SPA, correct?
Yes, but the insurer will also require a retention in the policy.
Yeah, understood. Okay, got it. But whether or not the buyer or the seller bears it was a negotiation in the definitive agreements between the buyer and seller.
Exactly. Yeah. And so somebody is going to bear that. The insurer just won't walk in. This is just insurance generally, how insurers price risks. And so this is just an old concept from insurance that we continue on with in reps and warranties. And it's also a way to keep people honest. Insurers want to make sure that claims being brought are legitimate. They're not the little stuff they ask you to sort of take care of first, and then once you hit a certain point, you're able to make claims against the policy. But all the claims are counted. So for even the little claims that are made, $50,000 or whatever, that's all counted in towards your retention. And then once you reach the threshold, you're able to make claims.
Yeah, it's sort of like a tipping basket in some regards, right?
Exactly.
Yeah. Okay. And then how long are these policies usually in force for, Matt?
The policies are usually in force for depending on the rep, they're 6-year policies. Yeah. So fundamental reps and tax reps are provided for about 6 years in the policy. The typical reps, general reps, that coverage goes out at 3 years.
Okay.
It's an advantage of the policy. The policy, you remember the old way of doing deals where you maybe got general rep coverage for a year or two. This gives you...
Yeah, I was immediately thinking, wow, for a buyer, this is tremendous. I mean, they've bought themselves 4 or 5 years of additional coverage, right?
Yes, exactly. And especially on tax and fundamental rep, going out 6 years, it's nice. And then especially for private equity, if they're flipping a target 4 or 5 years in, they can flip that target with existing rep and warranty coverage still in place. So,
oh wow, this is transferable,
yeah,
assignable.
absolutely.
Wow, that's tremendous. No additional fee for that. It's automatic in the policy.
Yeah, it happens. Right. No additional fee.
Wow. And the premium, Matt, is that a one-time premium, or are there annual fees for this, or is it just, you pay one time and you're done?
It's a one-time premium paid at closing or within 30 days after closing, and you're done. Yeah.
Got it. And that initial fee that you have to pay, can't remember what you called it, but the initial fee that you pay to start the underwriting process, does that go against the policy fee, or is that in addition to?
That's in addition to.
Okay. Got it. So, Matt, is there a downside to this? I mean, this seems like a tremendous product. And in addition to that, what are the thresholds? Like, what size does this type of insurance start to make sense?
The market has really adjusted over the last few years. So insurers used to, as of just a few years ago, they wouldn't really look at deals below $30 million. And today, policies are getting done on deals $20 million. I've seen $15 million policies be written. Sorry, $15 million deal size with a policy of, let's say, $2 million or $3 million. So that's kind of the threshold to think about. It's past that level of $15 million. I think it gets inefficient for people because the underwriting fee never changes.
Got it. Well, the pricing must have changed quite a bit to come down that far in the marketplace to $15 or $20 million deals. So these insurers are getting competitive. And as you said, there's about 20 of them in the country. There's
about 20, and they're competing heavily for lower middle market deals. And that's where, as you know, most deals are occurring these days. These lower middle market deals are all over the place. And
add-ons to portfolios.
Yeah.
We see it every day. I mean, that part of the marketplace is just exploding. Matt, talk a little bit, because with your legal experience and having been involved in that part of it, what is the negotiation like typically between a buyer and a seller when a buyer decides they're going to do this? How does that unfold between the buyer and the seller?
These days, what I see a lot is sellers requesting this in a term sheet. So sellers' law firms are saying right out of the gates in bid letters, term sheets, LOIs, buyer is going to need rep and warranty insurance. This will be a clean walkaway. So the negotiation starts there.
Oh, wow.
Yeah. I mean, I think that's where we are in the market now, where sell side attorneys really should be bringing it up with their clients. I think it's just good practice to do that, at least I think sellers' law firms really should. I'm not providing legal advice. That would be my suggestion to most attorneys these days, is try the LOI stage to insert this, because it will give your client a clean walk. So, and it will also set up the negotiation right away for whether or not you're going to use the product. And then once it's agreed, the purchase agreement language on how to insert this it's fairly easy. There's a few provisions that need to be inserted. In some cases, you see the indemnity section completely stripped out of purchase agreements because a seller will say, there is no remedy against me, and the only remedy you have is in the reps and warranties policy. So other times there'll be indemnity section saved in purchase agreements for special indemnities, or maybe there's also an escrow in addition to the reps and warranties policy, or there's a working capital escrow. But I think lawyers have got really efficient with knowing how and when and where to insert the provisions that you need to use a policy.
But if you're a seller, you shouldn't look at this as a way to cover your tracks, for fraud or misrepresentations, because you're still going to be liable if you committed fraud or you had a misrepresentation. It may be the insurance company that's coming after you, not the buyer, but somebody's going to come after you.
Well, just to be clear, there will be no subrogation right against the seller unless there's fraud. So a simple mistake in a representation, or I didn't know that was there, that's not something that an insurer can subrogate against a seller for.
Okay, got it.
Yeah, it's knowing that there's an issue with an intent to deceive the buyer, that the sort of definition of fraud. That's what sellers should think about. Otherwise, a simple mistake in a purchase agreement negotiation where the selling party didn't even have the information that there was a lawsuit or an employee issue, that's not going to be an issue that an insurer can subrogate against you.
Yeah, this is a tremendous tool to have available to you if you're a buyer and you're out in the marketplace and you want to separate yourself from all of the other buyers because it is such an active marketplace right now. It's crazy. And for decent deals out there, it's not uncommon to have many bids. And as a buyer, you can really separate yourself. Matt, are there things that we didn't cover today about this product that would be important for the M&A Unplugged community to know?
I think it's great to think about where the product is going. What we're seeing is we're still seeing lots of interest from insurers who want to be in this market. I talked a little bit about the difference between carriers and managing general underwriters. And I think that's an important distinction for buyers to think about as they look around for coverage. Traditional carriers are firms like AIG and Chubb and Hartford and names you think about in the insurance space as you watch a football game on Saturday. There's a new element to this market, which is called managing general underwriters. And these are underwriters that are also writing on A-rated paper. Everybody writes on A-rated paper. So buyers should always feel good that the insurer will be there for them. I've never seen this where an insurer has backed out or not been able or gone away. It hasn't happened. The paper is A-rated. And the managing general underwriters are writing for syndicates such as Lloyd's of London. They've been able, just by being a little more new to the market and a little more aggressive on terms, they've been able to change the market a little bit, force the market to do more creative things that are beneficial to buyers. So coverage has expanded a little bit since the introduction of managing general underwriters.
Well, and I would imagine, someone like you with your experience, both on the legal side and now, in underwriting and now offering this, you can sort of wade through that for buyers, right? I mean, you can bring them to the proper solution based on all of your connections, correct?
Absolutely. That's, I think, something that's value I'd like to think I have is just knowing the underwriters, knowing the markets, knowing who's able to cover what, who's interested in what kind of deals. And this is just things you learn at lunches in New York City when most of the underwriters are here in New York, and just things you learn about as you make your way around. So
yeah, I could see the value that you really bring to these, especially when you're talking about a process that has to move quickly. You really can't have delays, and which firms are doing deals in what industries, and you can sort of help cut to the chase here.
That's exactly the value that we like to add, as well as we do also, as part of a reps deal, we also do an incredible job. And I'm just going to toot my horn, Dominic. We do an incredible job on the diligence that an underwriter will expect to see. Underwriting this product really relies heavily on what insurance exists at the target company. So an underwriter needs to know that a target company has good insurance coverage in place in the first place before it will place this insurance. And most targets have this. But the people who provide that diligence are the people at ABD. And we'll do that for clients as part of the reps and warranties broking. We'll also provide diligence to the buyer that they can present to an underwriter on the underwriting call.
Oh, wow. That's a tremendous service.
Yeah, it's great. And we do a great job with it. And often we can point out things to the buyer that they didn't know about and improve the underlying insurance portfolio. We can work through issues that would normally be exclusions. We can hopefully provide increased coverage because there was pending exclusion because there was an uncovered issue. And we can often seek a solution in the market during the underwriting process, all in the background. This doesn't hold up the deal at all. And then present it back to an underwriter and hopefully get them comfortable with an increased insurance solution that covers whatever risk they were seeing in the deal that they may have been unwilling to cover in the first place.
Yeah, that's great. That is awesome. Matt, I've learned so much. This has been tremendous. I really see the value in what ABD is providing. I think this reps and warranty insurance, especially knowing that it's come down market so much, can really be a game changer. If people in the M&A Unplugged audience wanted to get in touch with you and learn more about this, how could they reach you?
The best way to reach me is my ABD email, matt.somma, there's 2 M's in Somma, at theabdteam.com. You can also find me on LinkedIn under Matt Somma at ABD.
Matt, real pleasure. And I'm so fascinated by this product. I'd love to invite you back maybe at a future time, and maybe we could do the anatomy of a deal. You could break down an actual deal for us that you got involved in and how it went and maybe some of the issues that had to be overcome. I think it would be great to do one of these with a deal. I understand confidentiality needs to be held, but maybe we could talk about the deal in the abstract so people can get a flavor for how this process works.
Sure. Yeah, that would be my pleasure. And there's lots of examples.
Yeah. Thank you so much for coming. Folks, some great information today from Matt Somma. If you're a buyer in the audience and you're looking at lower middle market deals and you want to be competitive, I'd give Matt a call. This seems like a great product. And if you're a potential seller in the audience and you want to walk away with the lion's share or all of your proceeds, be talking to your counsel about getting this into the term sheet, or to your M&A intermediary about getting this into the term sheet so that you can walk away with the lion's share of your proceeds, assuming that there's not an earnout or some other things, a seller note, obviously, but the cash portion being, walking away with that and not having to deal with an escrow. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com. or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.